Today's markets are increasingly tough to navigate. Are you ready to hear some crucial insights that can help you coach your clients? Welcome, I'm Aquele Parker. We're glad to have you here today for another informative analysis from Vanguard. In this video, Fran Kinniry, head of our Investment Advisory Research Center, will talk about why it's important to stay the course during market volatility. He'll explain clustering, where the market makes big swings in a short time, and how missing a few of the best days invested in the market can really affect long-term results. He'll also discuss how active management and regular rebalancing can help keep client portfolios on track with their financial goals. We hope you find this session as enlightening as we do. Don't forget to like and subscribe if you enjoy the video. Now, let's jump in.
Hi, I'm Fran Kinniry of Vanguard's Investment Advisory Research Center. Given all the market volatility, I wanted to share some of our team's research that hopefully will help you. I'd like to start off by sharing this illustration with you. What this illustration shows is the best and worst days of the S&P 500, and it shows how they tend to cluster together. I'll walk you through this, and what you see is that yellow line at the top. Those would be days that are above 3%, where the daily market return was above 3%. The bottom line is the days where the market was down 3%. And what you can see, look at the very beginning of that is COVID. And what you see is many days there clustering, up 3%, up 3%, down 3%, down 3%, and some days, above and below 5%. And so the key to take away from this chart is that volatility clusters, and the best days and the worst days tend to cluster close together. You can see up in the upper right quadrant here, there's only a 2% chance of having a plus or minus 2% day. But once you have that 2% day, there's an 80% chance in the near future of having a day that's plus or minus 3%. So volatility and daily moves cluster in both directions. So that's the key takeaway. Now let's take us up to 2025, this year. The first quarter, we actually saw normal volatility. We did not have a single day where the market was up or down 3%. Come the beginning of April, as we all know, in the markets, April 4th, April 5th, we had negative 5+% return, negative 5+% return 2 days in a row. And things looked really bad. The narrative was pretty tough, only to turn around on April 9th, the market was up over 9%. And so again, I think you're seeing a pattern similar to that of COVID, of really large spikes intraday and at the daily close in both directions. So please understand that how these best and worst days tend to cluster together. The implications to that are that if you miss one of the best days of the market, and again, they can cluster around some of the worst days of the market, you can really harm your client outcomes. For example, imagine if you missed that April 9th return where the market was up close to 10% because you got shaken out in the earlier part of April where the market was down 5% 2 days in a row. Now again, no one is going to be the worst market timer in the world, so please take this illustration for what it is. But what you can see here is if you were invested in all of the days with $100,000 over this time period shown, $100,000 would grow to $4.9 million. If you just happen to be the worst Charlie Brown investor, if you will, and you just happen to miss the best 10 days of the market, again, just hypothetically, no one is going to be that unlucky, the returns drop more than half to $2.3 million. You can see the other, missing 20 best 20 days, 50 best days. The key is that the fact that the market does cluster in both directions, positive and negative, and you can clearly see that in the early part of April of 2025, had you missed that one day that the market was up close to 10%, that can really hurt your long-term returns. So again, understanding how this clustering happens and making sure that your portfolios do not get shaken out all into cash. Now, I want to be very clear. What we're saying is not going into cash. Stay the course, and I really want to try to redefine what stay the course means. Stay the course is not buy and hold. Buy and hold is you invest and you hold. It's not set it and forget it. Set it and forget it is you buy it and you go away and you don't look at it. That is not what stay the course is. And so I think we need to redefine what stay the course is. Imagine you're on a ship, or you're using your Waze and you're trying to drive from your house to work. Well, there could be construction, there could be an accident. If you happen to be sailing a ship, the currents could be shifting you to the right, or the wind could be blowing you to the left. And so what stay the course really means is you know where you are today. I have a portfolio. I have a financial plan. I know where I want to get to. I may want to save for college. I may want to save for my retirement. So I know kind of where I want to get to, and I have a plan in place. No different than my Google Maps is directing me to my location. But along the way, there could be an accident. There could be construction. Well, enter the markets. The markets are volatile. And so stay the course. If your portfolio hypothetically was 60-40, and you get these days of -5, up 9, the markets are moving your portfolio, and your portfolio is becoming unbalanced. We've been talking on my team. We write a quarterly commentary. We write the Vanguard risk speedometers. We're the authors of Vanguard's Advisors Alpha, about how important it was over the last 5 years to rebalance into fixed income, right? The equity markets prior to 2025 have been on this unprecedented positive returns, and especially over bonds. And so a set it and forget it or buy and hold portfolio 5 years ago that was 60-40 would have had way too much equity risk entering into 2025. So again, stay the course is not set it and forget it. It's not buy and hold. It requires disciplined rebalancing. And rebalancing is hard. It's very emotional because you're selling your best performing asset and putting it in your lowest performing asset. It could also create taxes. And so this is where advice and the value of advice is so critical. And you as advisors working with clients, helping them through these moments that matter. And these are really critical moments when you see the markets of -5, -5, +9. And really stay the course is anything but passive. It's an active conversation. It gives you the ability to reach out to all of your clients, to talk about how the portfolio was assembled, that we had a financial plan in place, and the markets did this, and the portfolio was stress tested for events like this. But it's also okay to think about maybe the client had too much risk. Maybe they filled out a risk questionnaire, or they did your interview in very quiet times, low volatility, or in a giant bull market. Right? We can all be equity heroes or have a high risk appetite when volatility is low and you're in a bull market. So, changing your asset allocation over time is no different than any other life event, like a loss of a job or selling of a business. It doesn't mean that you should be tactically allocating your portfolio, but if you recognize that clients were in the wrong asset allocation at the time, and then you get a bear market and volatility like this, and again, let's just say they're 60-40, and after talking all that through, you think maybe that client is better off at 40-60, there's nothing wrong with that. The key is making sure that the client does not go all out of the market and into cash. Ideally, you would like to try to, keep them in their asset allocation. That's the asset allocation you thought that was prudent for them in the beginning. But again, when the asset allocation gets built, is very, very dependent on the environment of when they fill out a risk questionnaire or when you onboard them as a client. and they're talking to you about loss aversion and risk aversion and how they may feel if the market declines 10 or 20%. That may be a hypothetical conversation, and really when you actually see your balances drop 10 to 20%, maybe the asset allocation isn't the right asset allocation, and it gives you something to talk through with your clients. Making sure that they have the right asset allocation at that time is no different than a life event, like a birth of a child, loss of a job, hitting the lottery. So we want to make sure that stay the course is understood properly. It is an active strategy. It's an engaging strategy. It's a strategy where you are engaging with your clients to either recalibrate to the market because the market may be selling off, or as we were saying all of last year, 2024, because the equity market was so strong, selling stocks to rebalance into fixed income. And so it is a very active, proactive process of, again, staying the course, navigating what the currents and the wind may be doing in a sailing analogy. But the markets here are that wind and the current, taking your plan on or off course, or maybe the destination was even different than you thought. And if that's the case, having the conversation with the client to make sure that they have the right asset allocation for the next potential bull market or bear market. I appreciate you listening. I appreciate all you do for your clients, and good luck getting through the markets.
If you found this video about market volatility helpful, give it a like and subscribe to our channel. And be sure to turn notifications on so you never miss an update from Vanguard.